Goldman Sachs filed its Q1 2026 13F on May 15th, just 10 days ago. The same bank that held $152 million in spot XRP ETFs 4 months ago now holds zero. Not reduced, not trimmed, zero. Every last share. Today I'm going to show you what that filing actually says, what Goldman was really doing, and why the institutional adoption story that is driving XRP community enthusiasm right now is a few different things being treated as one. And once you see the mechanism, you will not be able to unsee it. Before we get into the filings, two things happened over the long US weekend that are worth knowing about. The US holiday weekend saw a two-act story unfold. Bitcoin dropped below $76,000 Friday on Iran war fears, recovered Saturday on peace deal news, and is sliding again this morning because Iran says there's no deal yet. ETH, XRP, and Sol moved with it. They always do. This marks the second consecutive week of BTC outflows, bringing the total to over $1 billion. And Vitalik spent his weekend on X explaining why the Ethereum Foundation is shrinking and promising it will sell less ETH. This matters because the Ethereum Foundation punches above its weight. It holds just 0.16% of all ETH, but its sales and decisions move markets and set the cultural tone for Ethereum. The foundation is generally seen as the central authority of Ethereum. That sentiment is something Vitalik continues to vigorously fight against. Both of those are institutional behavior stories, and institutional behavior is exactly what we're going to dig into. Let's get into it. First up, the Goldman Sachs shift in XRP holdings. Like all large institutional investors, Goldman Sachs is required to file a quarterly holdings report with the U.S. Securities and Exchange Commission, their SEC Form 13F. They tell us exactly what a large institution holds at the time of filing. So, when Dr. Felix Farsider 2346 left a comment in my recent XRP video about large institutional investors loading up on XRP, I went to the 13Fs. In the fourth quarter of 2025, Goldman held $152.2 million across 4 XRP ETFs. In the first quarter of 2026, Goldman held zero. The $152.2 million last year was held across 4 XRP ETFs, $39.8 million at Bitwise, $38.5 million in Franklin Templeton, $38 million in Grayscale, $35.9 million in 21 shares. Goldman was the single largest disclosed institutional holder of spot XRP ETFs on the planet. At the time, that $152 million represented roughly 73% of all disclosed institutional XRP ETF holdings combined. The community called it institutional adoption. Forbes ran the headline. Goldman Sachs revealed as top XRP ETF holder. The narrative was set. This context is largely missing from crypto reporting, though. Goldman didn't just liquidate XRP. Goldman also fully liquidated its Solana ETF position that same quarter and cut its Ethereum exposure by approximately 70%, leaving only about $114 million in BlackRock's Ethereum ETH-A. On Bitcoin, though, Goldman's Bitcoin ETF position, it's close to $700 million across BlackRock and Fidelity, and it was essentially untouched. That is not a crypto exit. That is a concentration. Everything else goes, Bitcoin stays. Goldman hasn't said why. So, what can we tell about Goldman's actions? The answer is in the structure of the position. Bloomberg Intelligence analysts James Seyffart and Balchunas noted at the time that the XRP ETF investor base was overwhelmingly retail, not institutional, and characterized the institutional participation as facilitation rather than directional conviction. The Q1 outflow kind of supports that. This was not a long-term bet on XRP. When the facilitation window closed, their position came off their books. 1 quarter in and out. There's still another layer to this. While Goldman was selling off roughly 73% of all disclosed institutional XRP ETF holdings, XRP ETFs experienced net inflows. That means not only was the Goldman position bought up, but more was as well. The week Goldman's exit was disclosed, XRP ETFs posted a $60.5 million net inflow, the single best week in 2026. So, who was buying while Goldman was fully unwinding its position? No large institution stepped in. UBS, the world's largest wealth manager with $5.7 trillion in assets, disclosed its own XRP ETF position in the same Q1 filing window. Their total? 197,369 shares in volatility shares and 317 shares in grayscale. Bank of America and RBC also each disclosed small first-time stakes in XRP ETFs in their Q1 2026 filings. That is not a replacement buyer, that's the compliance department testing. Crypto exchange Femex asserts that retail absorbed the Goldman exit. My research says the same thing. Retail is now holding the position Goldman held for 1 quarter and walked away from. That is not an accusation, that's just the math. Before Goldman unwound its entire XRP ETF position and no institution picked it up, Bloomberg Intelligence assessed that 84% of XRP ETF holders were retail, the other 16% were institutional. And remember, Goldman's $152.2 million was roughly 74% of that 16%. The 13Fs show institutions are not loading up on XRP. They show quite the opposite. But the 13F doesn't show everything. We have to dig deeper. That's next. If this is the first time that you're hearing about or seeing the actual filing data instead of the community headlines, subscribe now. This channel is where the filings go when the press coverage doesn't. SEC Form 13F applies to institutions providing discretionary management, which means firms managing someone else's money. You don't file one if you're managing your own. At least 4 groups are completely invisible to this system. Individual whales buying through personal brokerage accounts regardless of size. Family offices with less than $100 million in total AUM, not XRP ETF specifically, total assets. Foreign institutions not subject to SEC disclosures. And anyone holding direct XRP rather than ETF shares. So, could a single undisclosed whale have absorbed Goldman's entire exit quietly? Let's look at the trading data. The Bitwise XRP ETF, the largest of the 7 funds, trades approximately 585,000 shares per day, roughly $8.8 million in daily dollar volume. Across all 7 XRP ETFs combined, total weekly trading volume for the week Goldman's exit was disclosed was $137 million. That sounds large, but Goldman's $152 million position was unwound over a full quarter, 90 days, which works out to roughly $1.7 million per day in selling across 4 products. That is well within normal daily volume. A buyer absorbing that at the same pace would leave no anomalous footprint in the trading data. So the honest answer is, the volume data doesn't prove a shadow whale was operating, but it doesn't rule one out either. What it tells us is that the XRP ETF market is liquid enough to absorb a $150 million position in either direction without a detectable signature. Here is what the data does tell us clearly. Bloomberg Intelligence's 84% retail figure came from Q4 2025, when Goldman's $152 million was still part of the institutional 16%. After Goldman's full exit in Q1 with no comparable institutional replacement, that institutional share dropped further. So the 84-16 split is the most generous version of the institutional adoption case. The current reality is even more lopsided. Now, one more point that doesn't get discussed often. Everything we've covered so far, the 13F filings, the ETF flow data, the Bloomberg Intelligence breakdown, it only covers XRP ETFs. It says nothing about direct XRP holdings. And here is where the disclosure picture gets even murkier. Direct XRP holdings, whether held by an individual, a hedge fund, or a sovereign wealth fund, are completely invisible to the 13F system. The 13F only covers US-listed equity securities. Cryptocurrency held directly is not reportable under 13F, period, regardless of the size of the position. A hedge fund could hold $2 billion in XRP on the XRPL and file a 13F showing zero crypto exposure. Legally, accurately, the public would never see it. The only reporting that touches direct crypto is tax disclosures to the IRS, and that data goes to tax authorities, not to you, and not to me. So, what public disclosures are there about direct XRP holdings? Well, there are not many, but one of them we found out was fake. Here's what we need to know. 8 companies had announced XRP treasury strategies by January of 2026, with combined commitments exceeding $2 billion. The most concrete? Evernorth Holdings and its affiliate Pathfinder Digital Assets disclosed holding 473 million XRP as of the end of 2025. They did that through an SEC filing, which was required because they're going public through a SPAC merger. They had to disclose. Most of these institutions don't. The biggest name that was an institutional XRP holder, SBI Holdings, is Japan's dominant financial services conglomerate with $212 billion in total assets and $430 billion in securities under management. They became a live test case for exactly this question. Earlier this year, an X post went viral in the XRP community claiming that SBI held $10 billion worth of XRP tokens. The story spread fast. SBI has been Ripple's most important institutional partner since 2016. It co-founded SBI Ripple Asia, runs Japan's only live XRP remittance corridor, and has integrated XRP into its shareholder rewards program. The community had every reason to believe SBI was all in on the token. Then the CEO corrected it personally on X. He wasn't required to. No regulator compelled him. The claim appeared in a social media post, not in a prospectus or a filing. He chose to respond. And what he said is worth reading carefully. Not $10 billion in XRP. It's actually about 9% of Ripple Labs. This means our hidden asset could be much larger. That is not a denial of conviction in the Ripple ecosystem. That is a CEO telling the market that his company made a smarter bet than the community assumed. Equity in the company, not tokens. A 9% stake in Ripple at a $50 billion private valuation is worth approximately $4.5 billion. It does not fluctuate with XRP's daily price, and it appreciates if Ripple wins enterprise contracts regardless of whether those contracts settle in XRP or in RLUSD. SBI's position is a bet on Ripple the company, not on XRP the token. And the CEO said so, voluntarily, in public. That is the same conflation we've been tracking throughout this entire video, and it came from the mouth of Ripple's most committed institutional partner. With a relatively large direct XRP position debunked and a series of smaller positions held by XRP treasury companies seen, could there be unseen whales? Until very recently, the answer was mostly no. Here's why. The XRP Ledger is a public blockchain. Every wallet, every balance, every transaction has always been visible to anyone with a blockchain explorer. Analytic firms like Sentiment read that ledger and analyzed it continuously. A $500 million institutional position in direct XRP would appear as a whale wallet. It would be found. The on-chain data would show it. That changed in April 2026. The XRP Ledger integrated zero-knowledge proofs, a cryptographic privacy layer that allows institutions to confirm a transaction is valid and confirm it's compliant without revealing the amount, the sender, or the recipient. The stated purpose, in Ripple's own words, is to let institutions transact without exposing trading strategies or treasury positions to competitors. The ledger just got a privacy layer specifically designed for institutional use, which means the question of whether large institutions are quietly accumulating direct XRP, invisible to the 13F system, and now potentially invisible to the public blockchain as well, has no clean answer. Before April 2026, the absence of visible on-chain accumulation was meaningful. After 2026, the ledger can keep its secrets. That is not an accusation. It is the structure of the system. And it is the honest answer to the question Dr. Felix Farsighter 2346 was actually asking, even if he didn't know it. So, with that codicil, let's look at the ledger data as directly as we can. It's time to dig into direct XRP holdings. We've exhausted the XRP ETF research for the moment. We dove into institutional holding of XRP and looked at available information. Now, let's look at direct XRP holdings. For that, we need to look at the XRP Ledger directly. The XRP Ledger is a public blockchain. Every wallet, every balance, every transaction is visible to anyone who wants to look. The analytics firm that reads it most comprehensively for XRP is Sentiment, a blockchain intelligence platform that has partnered directly with the Ripple team and serves as the primary data provider for XRPL on-chain metrics. When Sentiment publishes wallet data, it is reading directly from the ledger. This is not survey data or estimates, it is the actual count. As of mid-March 2026, the total number of activated XRP Ledger addresses has reached approximately 7.85 million. But on-chain wallets only tell part of the story. Millions of XRP holders never create a personal wallet. They hold on Coinbase, Binance, Kraken, and dozens of other platforms where their XRP is held in exchange custody on their behalf. When you reconcile on-chain wallet data with off-chain exchange users, the estimated total number of unique XRP owners globally is between 18 million and 25 million people. That is the universe. Now, let's look at the tiers within it. Sentiment data shows 332,230 wallets now hold at least 10,000 XRP, which is the highest count ever. It's incredible. Out of more than 7.7 million activated XRP addresses, that puts a holder roughly in the top 5% globally. At current prices, 10,000 XRP is worth approximately $13,800. These are not institutions. These are high-conviction individual holders, people who've been in XRP long enough and with enough commitment to accumulate a five-figure dollar position in a token that has spent most of 2026 declining. And then the millionaire wallets, the ones that hold at least 1 million XRP each. Sentiment reported that from October 1st to December 31st of 2025, the number shrank by 784, from a peak of approximately 2,785 down to about 2,000. That's a 28% decline in the millionaire cohort in 3 months. Those wallets did not fall below the threshold because the price dropped. The threshold is measured in tokens, not dollars. Those wallets sold. The number recovered by 42 in the first weeks of 2026, and Sentiment counted 2,016 wallets in millionaire territory as of January 28th. At the highest end, Sentiment data from mid-May 2026 shows 507 wallets holding 10 million XRP or more. Together, those 507 wallets control 45.83 billion XRP, the most that cohort has held since May of 2018, and approximately 68% of the total circulating supply. That concentration sounds alarming until you understand what those wallets actually are. Binance's cold storage, Bithumb's cold storage, Uphold, Kraken, Coinbase, and every other major exchange holding XRP on behalf of their millions of retail users. Ripple's own operational wallets and escrow accounts are included in that. When the XRP army points to top wallet concentration as evidence of institutional conviction, they're mostly pointing at exchange custodians holding retail money. At today's price, 1 million XRP is roughly $1.4 million per wallet. The XRP community celebrated that number when Sentiment reported it. They should. It is a genuine signal of long-term conviction from large individual holders accumulating through a significant drawdown. there's no clear evidence of institutions or whales stacking XRP bags. There is a strong picture of retail doing so through exchanges and through ETFs. And there is absolutely evidence of 1,500 or 2,000 millionaire wallets keeping their dime in hands and waiting for the boom. Is retail ETF ownership a bad thing for XRP? No. Does the 94% retail ownership of XRP ETFs worry me? Also, no. But it is structurally different than what's happening with Bitcoin, and that difference has a price consequence worth understanding. When Bitcoin spot ETFs launched in January 2024, they were also retail heavy, roughly 80% retail in the first year. But the institutional share started climbing almost immediately. By the end of 2024, institutional 13F holders had reached 26% of total Bitcoin ETF assets. By mid-2025, sovereign wealth funds moved in. Harvard's endowment took a $116 million position in BlackRock's IBIT. Abu Dhabi's Mudabala increased its stake. By early 2026, Bitcoin ETF institutional ownership had reached 38%, up from 24% just 12 months earlier, with hedge funds, pension funds, and registered investment advisors collectively holding more than $40 billion. That rotation from 20% institutional to 38% institutional over 2 years is what drove Bitcoin from $40,000 to $126,000. And while those prices are great, I have previously covered the alarming nature of capture of Bitcoin's price by the institutions that have long-term negative implications for Bitcoin. XRP ETFs launched in September 2025. 6 months in, the institutional share sits at 16%. And that was the figure measured before Goldman's exit. The current number is obviously lower. Bitcoin's institutional rotation happened because pension funds, endowments, and sovereign wealth funds systematically increased exposure quarter by quarter. XRP's institutional story so far is Goldman in for 1 quarter on a trading desk facilitation, then out, replaced by compliance test positions from UBS, Bank of America, and RBC that together don't equal Goldman's first week. But those are all important steps, and I don't want to dismiss the chance to amplify it. Royal Bank of Canada, Canada's largest bank, $570 billion in assets under management, disclosed a position in the Bitwise XRP ETF in its Q1 2026 13F filing, published May 16th. Crypto Press, Canada's biggest bank enters XRP. Here's what the filing shows. Approximately 2,000 shares, valued at roughly $30,000, against a $570 billion balance sheet. Let me do that math for you. That's 0.000005% of RBC's assets. That's not adoption. That's a compliance department approving a test position, which is the same pattern every major bank followed with Bitcoin ETFs in early 2024. Small initial positions to establish regulatory infrastructure before any meaningful capital deployment follows. That is what RBC's $30,000 position actually tells you. Not that the institutions are arriving, but they are building the internal infrastructure that would allow them to arrive if the Clarity Act passes, if the regulatory framework firms up, and if XRP ETF's complex grows large enough for pension fund mandates to justify the compliance cost of entry. And there is one more detail. RBC was a founding member of Ripple's Global Payments Steering Group, the committee established specifically to develop governance around Ripple's technology. RBC published research years ago documenting that Ripple's network could reduce cross-border payment costs by up to 46% per payment. That research included a qualifier that matters, with or without XRP. The bank has known since before the ETF existed that Ripple's savings comes from the infrastructure, not the token. The RBC filing tells you one thing with certainty. Their compliance department has approved XRP exposure through a regulated vehicle. That is a regulatory milestone. Permission is real, but permission is not conviction. And $30,000 against $570 billion is not adoption. It is a starting line that the press is treating as a finish line. This entire video's research started with one comment on an earlier video. Is the world loading up on XRP? The answer is no. But the better question is, what would make that happen? Before I get to that, I need to clear up something the video has been building toward without quite resolving. Way back in Chapter 2, I walked through corporate treasuries holding XRP directly. 8 companies with combined commitments over $2 billion. Evernorth with 473 million tokens on its balance sheet. And then I said the Clarity Act would open the door for institutions to hold XRP directly. Those two things seem to contradict each other. They don't, but there's a distinction that matters. There are 2 different types of institutional actors in this story. The first type is corporations, companies that buy XRP the same way they might buy gold, real estate, or any other asset. No federal statute prevented Evernorth or Vivo Power from holding XRP directly. What they faced was commercial and reputational risk, not a legal prohibition. They could hold it, some did. The second type is regulated financial institutions. Those are banks, broker-dealers, pension funds, insurance companies, asset managers operating under SEC oversight. These institutions don't operate under commercial risk tolerance. They operate under compliance rules that require explicit federal guidance before they can hold, custody, or deploy any asset at scale. A court ruling says XRP is not a security in retail transactions. An interpretive release from the SEC and CFTC says XRP is a digital commodity. But neither of those is a statute. Compliance teams at JP Morgan and BlackRock and every pension fund administrator in the country need a law, not a ruling, and not an agency memo that the next administration could reverse. That is what the Clarity Act could do. That is who it unlocks. Not the corporate treasury market, the regulated financial system. On May 14th, the Senate Banking Committee passed the Clarity Act in a 15-9 vote. The bill now goes to the full Senate where it needs 60 votes. The White House has set an ambitious July 4th signing target. Polymarket puts full passage odds at roughly 75%. I'm not that optimistic. If the bill becomes law, XRP's commodity classification is locked into federal statute. Permanent. Not subject to reversal by the next SEC chair or the next administration. That removes the compliance barrier that has kept pension funds, endowments, and regulated asset managers structurally sidelined from XRP for the better part of 3 years. Standard Chartered projects $4 billion to $8 billion in XRP ETF inflows if the Clarity Act becomes law. Geoffrey Kendrick at Standard Chartered is the only institutional analyst with a named, sourced, specific dollar projection on the record. He's the only one. Every other number you see is either an AI model scenario or a price target contingent on inflows rather than a projection of the inflows themselves. So let's think about what $4 to $8 billion would actually mean. Bitcoin ETFs launched in January 2024 with Bitcoin trading around $46,000 and a market cap of roughly $880 billion. By October 2025, Bitcoin hit its all-time high near $126,000. Over that 21-month run, Bitcoin ETFs accumulated approximately $57 billion in cumulative net inflows. $57 billion in ETF inflows. 7 times what Standard Chartered is projecting for XRP in an optimistic scenario. And That $57 billion corresponded to roughly $1.7 trillion in Bitcoin market cap appreciation. XRP's current market cap is approximately $80 billion, just a fraction of Bitcoin's. The XRP ETF complex currently holds $1.4 billion in cumulative inflows. Standard Chartered's scenario adds $4 to $8 billion on top of that, in a market that is roughly 30 times smaller by Bitcoin's by market cap. The math on potential price impact, if the inflows materialize, is not the same math as Bitcoin. A smaller market absorbs inflows differently. I am not giving you a price target. That is not what this channel does. What I am telling you is the mechanism. The Clarity Act is the legislation. Statutory commodity classification is the unlock. Regulated institutional capital is the buyer. And $4 billion to $8 billion in new ETF inflows into a token with an $80 billion market cap is a very different equation than $57 billion into a $2.5 trillion market. Now, whether that happens depends on a Senate floor vote, a presidential signature, and then the speed at which compliance teams at the world's largest financial institutions work through their internal approval process. That is what you should be watching for. Not the headlines, the mechanism. Now, here's a quick math question about the mechanism. You didn't know there was a quiz. When Bitcoin embraced ETFs, or when ETFs embraced Bitcoin, I'm never sure which, every dollar of net ETF inflow corresponded to roughly $28 of market cap appreciation over that period. If XRP experienced the same situation, what impact would Standard Chartered's projection have on XRP's price? I'll leave that math to you. What I will say is that the answer has nothing to do with the three variables I dismantled in my last XRP video. This is a very different question entirely. That's what I think makes it worth asking. This pattern, infrastructure owners capturing the technology while retail holds the token, is documented across every major technology adoption cycle in my book, The Token Trap. It's available now on Amazon. There's a link in the description. I'm Dana Love, PhD. I'll see you in the next one. If this gave you something to think about, subscribe. I put out new analysis often. Drop a comment too. I answer as many as I can. And watch this one next. I picked it for you. Wherever you found me, I'm glad you did. See you in the next one.